We sit here today, the U.S. and Israel war with Iran is now into its second week, and financial markets have remained resilient, although with some volatility, especially in oil markets. Assessing risks of geopolitics, unfortunately, is necessary when managing client investment portfolios. But before we do that, we share our concern about the loss of life and property in wartime, and we hope for a quick resolution with minimal casualties and lasting peace. We also pray for our troops and their families. Since the initial strikes on Iran on February 28th, the S&P 500, the leading U.S. equity index, is down only slightly, but at one point early Monday it was down more than 3.5% before the market recovered from heavy selling, reversed, and then ended the day with a gain. Financial markets, aided by de-escalating comments from President Trump, now appear to expect quick resolution, and this would stabilize oil prices and reduce economic headwinds from the war. We caution against being overly optimistic regarding an immediate end to the conflict, however, as Iran's role in the Middle East, the oil and gas supply chain, and the global economy is very complicated and could easily lead to disappointment. The war has seen some flight to quality as U.S. equities have outperformed global equities, large cap technology stocks have led U.S. equity returns, and the U.S. dollar has strengthened. Perhaps surprisingly, however, U.S. interest rates have moved higher, while often in wartime interest rates move lower as investors buy U.S. Treasury bonds. This time, however, those rates are higher due to fears of a new round of inflation pressures driven by oil and gas prices, which have been the most volatile and represent the biggest source of concern for investors. The price of oil per barrel using West Texas Intermediate Crude, or WTI, ended February at $73 and closed on March 9th, Monday, in the 90s, and was at $81 per barrel in Tuesday trading March 10th. Intraday volatility was even greater as oil markets opened globally on Sunday night, and WTI traded as high as $119 per barrel, which was up 63% from the February close. The U.S. average price of unleaded gas was $3.48 per gallon on March 9th, up about 20% since the end of February, and compared to $3.09 per gallon 1 year ago in March of 2025. Of course, if you're on the West Coast like me, you're already paying more than the national average, but the increase has been about the same. The good news is that global leaders have met to stabilize global oil prices by releasing strategic reserves if needed, and the U.S. is working to backstop shipping insurance and provide protection for tanker ships to exit and enter the Strait of Hormuz. We remain constructive on U.S. equities for long-term investors, and we believe the S&P 500 index will be higher by year-end. But the oil price volatility is concerning and could lead to fits and starts for equities. Higher sustained gas prices will create headwinds for consumer spending, especially for low-income earners, and offset some of the positive effects of expected strong income tax refund season this year. In addition, higher gas prices will cause year-over-year inflation, and we estimate that every 10% increase in the price of gas adds about 30 basis points to the consumer price index. Higher inflation keeps interest rates higher, which can also restrict economic growth. Over the past 2 days, oil has moved lower, so the gasoline price shock fear has receded, but this could reverse, and again, we expect ongoing volatility. In the short term, we expect investors to find comfort in those large cap technology stocks, and we also like other defensive sectors and dividend payers. Defensive sectors include healthcare, utilities, and consumer staples. We think investors should stay the course, however. If the war is largely ended in March, we believe the U.S. economic growth trajectory will resume and cyclical exposure can be added. And this would include financials and industrials, two sectors that have lagged the broad market since the onset of the conflict. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.